The reason that we've gone so far for so long is because, well, two reasons really. One is we have a special place in the monetary sphere, meaning the United States, because it's the reserve currency of the world. Almost all transactions are settled in the dollar, although that's changing. It's the best one of all other currencies. For example, going back to Venezuela, Argentina, they'll take their local currency and exchange it for physical greenbacks because relative to their paper currency, it holds its value much better. So there's a huge bias to the US dollar as a reserve currency, but we've gotten to the point that I've talked about and actually thought it would happen sooner than it has. And so let me back up. So there were two reasons. The second reason, and when I figured it out, I promptly admitted my error, was in order to keep basically a Ponzi scheme going, you need more people to enter the game. And that's what happened in the early 2000s in a significant way with China. So when you added 1.4 billion people to the Keynesian model of banking, certainly that model works for a while. I would be, incorrect to say that Keynesian economics doesn't work ever. If it didn't work ever, we wouldn't use it at all. So obviously it works. And of course, China had this huge industrial revolution from roughly 2000 for the last 20 years, basically. So now we're at that tipping point, Jake. We're at that point where enough people in the market realize this can't go on much longer. And now we don't know exactly how it'll unfold. Of course, the central banks are willing to basically print for whatever failure they do. But that, again, means that enough people are waking up that, oh, I see. Not only are they never going to pay their debt back, but anytime something's wrong, the too big to fails will be rewarded for their mistakes. And so the 2008 crisis, which really was the precursor for where we are right now, probably we would have been better off just to let the banks that should have failed fail. These banks are too big to fail. So they're playing favoritism. And again, it was absolutely rewarding a mistake. If you make a bad loan, you make a bad loan. If you make a bad loan, you should pay the price for having made a bad loan, which means you don't get paid back. We've run out of road. We can't kick the can anymore. All nation states and basically the big money, the money that moves trillions in the currency markets, they're aware of what's going on. And we just haven't seen that tipping point of that trigger event where somebody moves too much money one way or the other, or some event happens where a big bank fails or a multiple amount of banks fail. The problem with the banking system is they're all interconnected. And if one starts to fail, it could take others down, which is what we saw in 2008. So since we papered over the 2008 crisis, we made it substantially bigger. We didn't learn our lessons at all. So the next time, which I think we're going to enter soon, will be devastating. The next financial reset, which we're really in, will definitely change everybody's lives, no matter how much money they have. These bankers are so arrogant and so elitist and have this attitude that they know what's best for everybody else, and they're forcing us into their system so they don't lose control, is arrogance beyond belief. But whether or not it'll work remains to be determined. In the meantime, and I know we'll get to this, there are measures that you can take at a personal level, family office level, money manager level, pension fund manager level that can mitigate the transition. Will cryptos save us? I don't know. I kind of doubt it. Will gold and silver save us? I would say more so financially than almost anything else I can name. The deal with the silver market, which again is a bunch of derivatives. I mean, the silver market is basically a paper market. And occasionally someone stands for delivery and takes delivery. And most of the time they take delivery, all they do is re-tag the silver pile in the warehouse. So they put a new tag on it, they take the JP Morgan tag off of it, and they put in HSBC on it. But occasionally some does actually come off of the COMEX and gets delivered somewhere. But it's not the primary delivery vehicle. It's not set up to be that. It's set up to be, again, a derivatives market based on paper. So what happens? Well, the truth of the matter is and I've tried to emphasize this the last several years, is all markets move at the margin, which means if I stand for delivery and I get my silver bar, that might be the last one they have that month that they can hand out. But as long as that demand is met, they're covering themselves because it's basically on a fractional reserve system. In other words, they know that less than 1% of all the contracts out there ever get cashed out for the commodity. That's true in most of the markets: corn, wheat, soybean oil, you name it. So this is the advantage that the shorts have, is they know that they can basically leverage it at 100 to 1 and not be called out. But that only lasts until it doesn't. So what I need to see is a massive amount of new buyers. And we're seeing, fairly, I won't say massive, but a substantial amount of new buyers since about February, when the Wall Street silver crowd showed up. I mean, silver never asked, are you buying an industrial bar? Or are you buying, retail 100-ounce bar or whatever? Silver. Now, of course, there are some, caveats to that, and I don't know if I should go into them or not. But I mean, the silver market's based on the 1,000-ounce bar market, not the 100-ounce bar retail market. Nonetheless, any silver that's taken off into physical possession helps the cause, so to speak, meaning that there aren't any games that can be played with it. They can't hypothecate it or rehypothecate it or write an option and swap it or lend it or all the stuff that happens in these markets. So the amount of volume that we saw in February, where we saw like 100 million ounces trade in a matter of a few trading sessions, was really huge. In fact, it triggered a couple of responses from two of the silver ETFs, the largest in the world, the SLV. The price of silver is not anything close to what the value is. And the value is probably closer to what, that cell phone or smartphone actually sells for. But no one trades in silver, except a few of us nut jobs. But if you go back 100 years, if you didn't have silver, you didn't have money. Think about that. If you didn't have silver in your pocket or silver in your bank account, you didn't have money at all. But now we transition from a silver standard or a bimetallic standard into this fiat fiasco frenzy. And the bankers keep telling us everything's fine, just look the other way, we have it under control, do as we say, we know what's best for you. And then, of course, and we haven't touched on this too much, is at the end of all these great inflations, there's always comes to the fore a competing currency. In most cases, it's been the precious metals. In this case, it's been the precious metals, which have taken a back seat primarily to the cryptocurrencies.